Hi everybody, and welcome back to X and Token channel and your host Superman. Let's get into it. We're going to look into is the US economy already in a recession? There's a really good article here on investing.com. I'm going to give a little bit of feedback and illustration of this. So let's get into it. Recessionary warnings at the moment are growing louder daily as the Federal Reserve deepens its hawkish stance to combat the highest inflation in decades. So let's just unpack this a little bit there. The Federal Reserve there is the central bank of the United States of America. And of course, hawkish stance just basically means they're being aggressive with whatever tactics they use. So we're going to look at that. And of course, the highest inflation in decades. Let's check it out. First, the US central bank raised its benchmark interest rate by 75 basis points at its June meeting, the most significant hike rate since 1994. Can you believe it? So interest rates there, what they're talking about is the federal fund rate there. So you can see that at the moment, the actual is 1.75, forecast 1.75 there, interest rate decision. So they've raised it by 75% as basis points, basically the federal funds rate there. It's a settlement a rate between banks. So it's a pretty big deal there. And of course, that flows into retail rates that you get for like getting a house mortgage, something like that. This is the biggest rate rise in substantial 75 basis point, pretty big one there. Typically, you might get, say, 0.25, 0.5%, but this is, or 25, 50% basis points, but that's pretty big there. And of course, imagine that being 0.75 percentage points, as it were. So 1% would be like 100 basis points. That's the way I'd look at it. The Fed, which has increased its Fed funds rate target by 150 basis points so far this year, also announced that it would start to reduce its massive $9 trillion balance sheet. And of course, this has been very massive in terms of expanding the monetary supply. So it's a very big deal there. And of course, that puts extra pressure on inflation. You can see the Fed rates here on the total assets they've got. You can see that after 2007, 2008, when we had that Great Recession with the big property and financial crisis there, we saw the Fed's balance sheet jump to $2 trillion. And then obviously it kept increasing. 2013, it jumped again from 3 trillion all the way up to 4 trillion there in 2014, etc. So it kept staying up there to about 2018 and then came down towards the end there of 2020. Obviously, then we had a big impact here with the COVID health issues. And of course, we also saw the new administration, Biden administration, coming in here. And of course, the Fed Reserve started pumping trillions of dollars into the US economy there with the balance sheet. And of course, it jumped all the way from 4 trillion all the way up to 9 trillion. So a massive amount of money printing there. Indeed, the Fed chairman, Jerome Powell, he's the head of the Federal Reserve there, again stressed this week that fighting inflation is the central bank's top priority, even at the risk of a recession. So that's a big warning sign there, folks. They're willing to fight inflation even at the risk of a recession. So to take that into account means that you really need to think about hedging the markets as they go down, or also your risk management as well in terms of preserving your wealth. And this is definitely something you should take heed on. Speaking at the European Central Bank's annual conference on Portugal on Wednesday, Jerome Powell acknowledged that the process would involve some pain. So there we are, folks. Not mucking around here. Judging by the latest data, U.S. economic growth slowed sharply in June, with deteriorating forward-looking indicators setting the scene for an economic contraction in Q3. Additionally, consumer confidence is now at a level that would typically herald an economic downturn. Now, remember that 70% of the GDP or gross domestic product, that's kind of like your national income indicator, is based on consumer consumption. And of course, a big key indicator from that is consumer confidence. Are those consumers confident? And of course, this is what this is looking at here. US data surprised index cycle at cycle lows there. We can see back in the COVID correction here in 2020. We got the COVID crash, and of course, you can see how we're down here at 40% at the moment, and confidence. So the confidence is quite low on consumers. Not surprising given all the inflation and all the other hectic things going on out there in the economy. At this point, a recession seems inevitable, and I think that's a fair comment there. The question is, when does it begin? So if going by the Atlanta's Fed's GDP forecast tracker, which provides a running estimate of real GDP, growth based on available economic data using a methodology similar to the one used by the US Bureau of Economic Analysis, the economy is already in a technical recession. So that's the key outtake there. According to the latest model estimate, growth in the second quarter of 2022 has been cut to contractionary, a -1%. So that doesn't bode well at all as of June the 30th. 30th there. That's down from 0% on June 15th. So obviously a decrease there in expected GDP, and compares to a growth of 1.3% on the 1st of June. So they thought they would have a 1.3% growth, and it looks like it's going to end up with a negative 1% there for the second quarter. So big deal. We can see that the evolution of the Atlanta's Fed, the real GDP estimates for Q2. We can see that we had a consensus here, all very, very popular. So a lot of people having their views, and the consensus showing the top 10, top 20 bottom range. So we're looking at around 3% growth there, with the bottom just under 2%. But we can see that the Atlanta Fed's estimate is way down at negative 1%, and it dropped down below here. It was sitting over 0, almost up at 1%, but dropped down negative 1 there. So if that's correct, then obviously that's our second quarter of negative GDP there. Within the US economy, contracting by 1.6% in Q1. So we just talked about Q2 expectations. Q1 was 1.6% negative. That would technically mean a definition of a recession, 2 consecutive quarters of GDP. So if you're wondering what a recession technically is, it's basically 2 quarters. That's 2 periods of 3 months. In other words, a total of 6 months where you've got reducing GDP. And of course, that's what we see there. Interesting, the latest survey of Wall Street professionals by Deutsche Bank showed that 17% believe the recession started this year, up from 13% last month and virtually 0% in February. So you're having a lot of people going from 0 expectations of a recession now to 17%. So it's a big deal there. You can see how that has changed. So in December 21, they're expecting a recession in 22 was very, very low. You can see it's very low in January and February. But by the time we got to April, May, and June, it's back up here, expecting a recession in 2022 of 17%. Big deal there. We've got 71%. They're also growing for 2023 there, so pretty crazy. Now, a recession typically may last about 18 months, so we'll see whether that happens or not. Sometimes it can go longer, just the way it is. We'll see. The benchmark S&P index wrapped up its worst first half since 1970, down 20% the year to date, and roughly 22% below its January 3rd record close, meeting the technical definition of a bear market. So we've got bear markets and stock markets as well happening. Those typically show a sign. So if the recession deepens, then we could expect the stock market retrace and bear market to deepen as well. Meanwhile, the technology heavy NASDAQ composite, which slumped into a bear market earlier this year, is off by 29% and 32% away from its November 19, 2021 record high. Its largest ever January to June percentage drop as well. The Dow Jones Industrial Average, so this has a lot of the top 30 companies in it in the United States, so that's also down. So the techs is down. The Dow Jones Industrial Average down as well, 15% year to date. It's a significant half year or first year slump since 1962, approximately 17% of its all-time high at the start of the year. So finally, you can see those indices of the Dow Jones, S&P, and the NASDAQ. That's all the stock market indicators there of representing all the firms on the stock market, all down there on a percentage basis. There you can see all the percentages, pretty big deal. So with inflation hurting consumers and businesses and the Fed rapidly raising interest rates as a result, along with ongoing global supply issues, the economic outlook for the second half of 2022 looks difficult at best. So just take that into account to keep monitoring that. Hope you enjoyed this big update there. Once again, you can look at your risk management and other things accordingly as we have possibly a deepening recession, entering recession, all that sort of stuff, and possibly a further bear market retracement. So definitely things to take into account as well. Obviously, not investment advice, just my opinions, but I wish you the very best there. Don't forget to subscribe, like, share, hit the bell, and I'll catch you in the next one. Bye for now.